Let's kick off with the activity that we saw on the day yesterday. As I said, 70% of the trade really centered around one stock. This just indicating how light trading is at this point in time.
Yeah, it seems Scan Group is usually not amongst the top traders on the day due to its low float. So when you see Scan Group accounting for 70% of trading, it means then that market activity is down. But Scan Group was mainly because of the WPP transaction, and that's why maybe you could see some foreign investors being interested in the stock. But it's usually a reflection of low activity in the market.
Right, let's focus in on the banking sector. We've really seen a story of two extremes when it comes to the interest rate environment. We started off with commercial bank lending rates at the beginning of the year sitting around 14%. They're now sitting at around 25%. We've had 4 interest rate hikes this year, and no surprises that we've seen a sell-off in the banking sector as a result of the concerns around the difficult operating environment.
Yeah, indeed. The interest rates are very volatile in Kenya, especially this year. But I think the interest rates at the moment are transitory, because the last 7 or so years we've seen stable interest rates with T-bill rates not exceeding 10% for the last 7 years. So it's been a really tough year for Kenyan banks, especially with regards to valuing their bond portfolios and the threat of default. And those are going to be some of the key themes going forward.
Let's just focus in on some news flow out of the banking sector. CFC Stanbic shareholders have approved the rights offer for 2012. The stock reacted positively to that news. That stock has been one of the worst performing stocks in the banking sector. What are your thoughts on this? Just indicating, shareholders indicating that management is on the right course?
Well, that's part of the thing, but the bigger thing is that they have to grow, and you won't grow without capital because of the capital adequacy ratios. I think the managing director said that if they don't boost their capital, then they can only grow for the next 6 or 9 months, and after that they won't be able to grow. So it's really a business contingency that they have to do to grow their capital. But nonetheless, it's an industry-wide phenomenon, with Cooperative Bank and Standard Chartered as well lacking capital. And I think next year an investor would be suited to investing in banking stocks that have adequate capital, because those are the ones that will be able to grow their loan books faster. And in any case, when they need capital, they'll come into the market when the markets are looking pretty good, maybe in 2013.
Interesting that they are coming into the market, though, in 2012 with concerns around where the equity market is going. Before we focus in on key themes for 2012, let's just take a quick look back at what we saw playing out in the banking sector in 2011. Just looking at the performance there, Barclays and KCB really the only two counters that have outperformed the NSE 20. KCB just beating the NSE's 20's 28% drop by around 1%, and Barclays almost 9% better than what we saw from the NSE 20. From your perspective, which bank stocks were standouts for you?
I think, as you mentioned earlier on in the year, the key thing for banking stocks at the moment is deposit mobilization, and a diversity in deposit mobilization, not necessarily like a bank that is very focused on either wholesale funding or consumer funding. And I think KCB and Barclays have a well-diversified liability side of their balance sheet, and they've got good deposit mobilization capacities through their branch networks. And this really affects now things like liquidity, because banks that probably rely on wholesale funding, and some part of last month, banks were even paying up to 28% for corporate depositors. So you need a bank that has good deposit mobilization so as to access low-cost funds. And I think that's maybe why KCB and Barclays have not performed as badly as the rest.
That's the key, really, as badly, because all those banking stocks are severely depressed. As we go into 2012, most are saying that the banks are really offering attractive discounts at this point in time of the banking stocks. Then which ones are most attractive to you based on your key investment criteria for 2012?
I think one thing is that you'll have to look at dividends. And that way, I think the only banks that could be paying dividends over the next few months are KCB, Equity, and probably Barclays. And that's one of the things, because the dividends will protect your downside. At least you're sure of a dividend. Secondly, you'll have to look at the capital adequacy ratios. I think KCB and Equity also sitting very pretty on that because of adequacy ratios of 17–16%, and that will work well for them growing in terms of growing their loan books. And thirdly, I think the key thing is the threat of non-performing loans. And one way that they could mitigate that is having already good profits over the year. So KCB and Equity have had good profits. So even if they are to provision for non-performing loans, I don't think it will affect profitability as badly as some other banks in the industry. So I think KCB and Equity are a safe bet for an investor going forward.
We've seen a lot of activity centered around those stocks in the December month, particularly from foreign investors. Going into 2012, how much appetite would you say you need to have for risk when you're looking at investing in Kenyan banks? Would you be saying that they are offering too attractive levels to not get into them at this point in time? Or would you say that banks, say, in Nigeria are slightly more attractive and less risky?
I think there are a lot of factors to analyze in this issue. First of all, there's a looming threat of a crisis in Europe and a financial crisis in Europe. And that could have effects in terms of deleveraging of Eurozone bank balance sheets. And if any Kenyan banks or any African banks are exposed to that, then that could have bad effects. So I don't think I'm extremely bullish on banking stocks for next year. So I wouldn't say that you should go both feet and hands into them. I think there should be a cautious approach to them and analyzing all the factors that could play out, including a Eurozone risk. And with that said, I think that would mean that you look at banks that are funded internally rather than banks that require loans from abroad to extend to the local market.
Then how long, I mean, of course, we've had this banking sector under pressure for majority of 2011, really accelerated towards the second half of the year. From an investment horizon point of view, if there are a lot of ifs going into 2012, especially concerning what's playing out in the Eurozone, what would your investment horizon be for the banking stocks that you are looking at offering value?
I think an investment horizon would have to be more than a year, probably 2 or 3 years, but at least 2 years looking into 2013, because in Africa the markets change fast and it's an issue of sentiment. And once you see GDP growth slowing down, then sentiment turns against most African investment opportunities. So if you see good growth, or at least expectations from 2012 are not as bad as they come, then 2013 could actually be a good year for African investments. And I think that should be the horizon that investors are looking at 2013 and onwards to reap their returns.